Welcome to the question clip on Chapter 11, dealing with statements of cash flows. We're going to be dealing with a question regarding the statement of cash flows of a company. And if we have a look at the required part for the statement of cash flows, prepare the statement of cash flows for Tip-Top Limited for the year ended 30 June 20.7 by using the direct method. According to the International Financial Reporting Standards, we can only use the direct method now, so the indirect method is not to our disposal anymore. If we have to prepare a statement of cash flows, it's important for you to remember the framework for the statement of cash flows. So I'm just quickly going to run through this framework so that you can get your answer structured before you start reading the given information. Cash flow can occur under three subheadings: cash flow from operating activities, cash flow from investing activities, and then your cash flows from your financing activities. These three will then result in a net increase or decrease in your cash and cash equivalents. So you need to understand the concept cash and cash equivalents. That is all the funds, the money that you can get your hands on within 24 hours. So your current account and any deposits that you can request within 24 hours, your petty cash, your cash float, those will all be classified as cash and cash equivalents. Then, if we take this net movement in the cash and cash equivalents and we add that to the balance of our cash and cash equivalents at the start of the year, that will give us our cash and cash equivalents at the end of the year. So these three subheadings, as well as the last three items of your statement of cash flows, that will form part of your framework that you write down before you start reading the given information. Now, under the cash flow from operating activities, we're going to enter the cash results of all our operations. Now, another statement that reminds you of operating activities is the statement of profit and loss and other comprehensive income. So under this section, I'm going to deal with the statement of profit and loss and other comprehensive income. I can also not operate without my operating capital. Operating capital is my current assets and my current liabilities. So under the operating activities, I'm going to look at the complete statement of profit and loss and other comprehensive income, as well as current assets and current liabilities. And I'm going to try and isolate the cash flows from all of these items. If we then go over to the cash flows from investing activities, if you think about the basic accounting equation, I've got my liabilities and equity, which will be invested in my assets. So under this section, we're going to deal with our non-current assets. So from the non-current asset information that we have in all our other statements, we're going to try and isolate the cash flows resulting from transactions with non-current assets. In my cash flow from financing activities then, if you have a look at what remains in my statements, I've already dealt with this statement of profit and loss, current assets, current liabilities, and non-current assets. So I'm basically left with my non-current liabilities and my more permanent equity items, not your profit and losses, but your more permanent equity. If you now know what to look for under each of these headings, we can start by completing our framework under each of these headings. If we look at the statement of cash flows from operating activities, or the cash flows from operating activities, we start with the cash received from clients, which is a calculation in its own right. And then we're going to go over to the cash paid to suppliers and employees, another calculation, and a subtotal here for cash generated from operations. There's a number of separately disclosable items, according to IAS 7, that we have to show as separate from cash receipts from clients and paid to suppliers and employees. This separately disclosable items includes interest paid, interest received, if we had any, dividends received and dividends paid, and then the final one, taxation paid. All of these finance costs and income is items very important for prospective investors. That's why they want it separated from the other cash receipts and cash payments. And the taxation paid is something that you as an entity does not have control over. So that's also a separately disclosable item. It's important to identify these separately disclosable items early so that it can be adjusted in the first two calculations already. So we're going to start with the calculation of cash receipts from clients. We mentioned that this is the statement of profit and loss and other comprehensive income. And this statement of profit and loss and other comprehensive income starts off with revenue. From revenue, we deduct our cost of sales to get to our gross profit. We then add our other income, deduct our other expenses, to get to our profit or loss for the year. So we're going to start with the revenue item. That's the starting point of our statement. And we're going to use the revenue item and adjust it so that we can get to the cash receipts from clients. Now, if you think about revenue, revenue includes cash and credit sales. Cash and credit sales. We're not interested in the credit sales for this statement. We're interested in the cash sales. So what we actually want to do, we want to take the sales, which is total sales. We want to deduct from the total sales our credit sales. But then we want to add back the amounts received from our debtors. That's the logic behind this. So we want to start with sales, deduct credit sales, and add back amounts received from debtors. In the question, they're not going to provide you with all of this information. If we have a look, they told us that our statement of financial position included the following items: our non-current assets, our current assets, equity and liabilities, and then they give us an extract from the statement of profit or loss and other comprehensive income. They just give us the gross profit with a profit margin, net expenses, profit before tax, the income tax expense, and the profit for the year. In the additional information, they give us following items that were included in the calculation of net expenses. So nowhere do they give us this split that we want to use to transfer our revenue to cash receipts. If you think about these two items, in which T account will your credit sales and your amounts received from debtors, in which T account will this be included? It will be included in our debtors control account. That is the reason why, to get to the cash receipt for revenue, we're going to reconstruct a debtors control account. Reconstructing the debtors control account will involve the amounts for trade debtors at the start and at the end of the year. And then we would like to use this gross profit amount to get to the amount for revenue, to get to the sales. If they tell you it's a 40% on sales, the gross profit, that means that my sales was 100%, gross profit 40, so cost of sales would have been 60%. So to convert the gross profit of 384,000 Rand to revenue, to sales, I would calculate 100 out of the 40 times my gross profit. So my revenue amount, which I will include in my debtors control account as sales, is the 960,000 Rand. I used my gross profit and my profit markup percentage to get to the sales amount. If I then take the opening balance of the debtors, that's my balance at the start of the year, plus the sales, and I took the total sales so that I can capture the amount that the debtors paid as well. So this balancing amount will represent cash sales and amounts received from debtors. That's why I put this sales amount here in the debtors account as part of a calculation. If I then include the closing balance for trade debtors, 53,330, as the closing balance, my bank amount for the amounts received from debtors will be 956,070, and I include that in my framework, 956,070, without a bracket, because this is cash received from clients. So far we've calculated the first item. We used the sales and we used our movement in the trade debtors because we wanted to isolate from my total revenue, we wanted to get it to only cash. If we now move on in my statement of profit and loss, to calculate my cash payments, I will start by using the second item, cost of sales. Cost of sales, again, was not a given amount, so we want to calculate the cost of sales. So I'm going to take 60 out of the 40 and multiply that with my gross profit. That gives me a cost of sales amount of 576,000. But cost of sales is a calculation in its own right. If you can recall, cost of sales is my opening inventory plus my purchases plus other expenses minus closing inventory. I'm not interested in opening and closing inventory for a statement of cash flows because opening and closing inventory can include credit purchases and I have not yet sold it, so it cannot constitute cash. So if you look at this calculation, I want to take out of this calculation, I want to take out the opening and the closing inventory so that I can be left with my purchases. To be able to do that, we're going to draw up an inventory account. Opening and closing inventory balances is included in an inventory account. So we start by reconstructing our inventory account. In the inventory account, I include my opening balance from my statement of financial position. So for inventory, if we can have a look there, opening balance of 57.5 and a closing balance of 66,600. So I had my opening balance of 57.5 and my closing balance of 66,600. If I then know that inventory will decrease with my cost of sales, and we calculated cost of sales using the profit margin, cost of sales of 576,000, if I deduct that cost of sales from the inventory account, my balancing amount for this asset will represent the increase in the assets. I still don't know whether this purchases was cash or credit. I've isolated the purchases part now, but now I have to identify the part that is cash and the part that is credit. For the sales, to isolate this, we drew up a debtors control account because we wanted to get credit sales plus money received from debtors. Here we want to deduct the credit purchases and we want to add amounts paid to creditors. So for this purpose, we're going to draw up a creditors control account. The creditors control account starts with a balance on the credit side and a closing balance on the debit side. Now you just need to read carefully. In my statement of financial position, they told me that I have trade creditors of 13,300 at the start of the year and 20,750 at the end of the year. But additional information number 1. Included in creditors on the 30th of June was 1,200 for accrued expenses. This has nothing to do with my trading activities. I'm still busy calculating payments to suppliers. So I can't include this 1,200 in my calculation of my cash purchases. So this was included in creditors on the 30th of June, and it represented trade creditors 30 June 20.7, only trade creditors. So my opening balance of 13,300 cannot be used in the creditors control account. I have to deduct from that the 1,200 Rand, which they told me is expenses still payable. That means that my opening balance is not 13,300 but 12,100. In my creditors control account, I start with the 12,100, 13,000 minus the 1,200. I end it off with the closing balance, which is pure trade creditors. I add to my creditors the purchases that I identified over there in inventory. Remember, that was the balancing amount. So that's the amount that I'm going to include in my creditors account. And then whatever I have as a balancing amount in creditors will be not only my cash purchases, but also amounts that I pay to creditors for my purchases of inventory. So my cash paid to suppliers and employees can start off with an amount paid to creditors for goods purchased, including cash purchases. So that 576,450 is the starting point of my calculation for cash paid to suppliers. Now they informed me about the accrued expenses, which we deducted from the opening balance. So we had accrued expenses of 1,200 Rand at the start of the year. If that changed from 1,200 to 0, accrued expense is a liability, so it's on the credit side. So to change a credit from 1,200 to 0, I had to debit the accrued expense and credit bank. A credit in bank will be a payment. That's why that decrease in the accrued expenses will be included as a payment. So it gets added to my cash paid to suppliers. At this point, in our statement of profit and loss, we dealt with the revenue and the cost of sales, so we are at gross profit level. I want to now include all the movements up into profit and loss for the year so that I can identify which of these movements were cash and which ones credit. Okay, so we need this information as a total amount. In the question, they gave us a summary of the statement of profit and loss. We had the gross profit, we are at that level, and then we have the net expenses. It's a calculation given for you of 218,480. So I can start with that as my net expenses. I start with that as my net expenses, but I know that included in net expenses, there might be items that is not of a cash nature. You can compile a list of this while you're busy preparing for the exam. Examples of expenses that is non-cash items. If you think back to Chapter 10, we already revised that. Depreciation is one of the non-cash items that will be in my net expenses, but it does not form part of my statement of cash flows. Another example will be amortization. Amortization for intangible non-current assets. Then an item like credit losses. You are never going to get the money back, so this is a loss that has no cash influence. So prepare a list of non-cash items that you know you have to take out, eliminate from the net expenses. Okay, we are not only going to adjust the net expenses with non-cash items, we are also going to adjust the net expenses with items that we have to disclose separately somewhere else. That's why when we discussed the framework, we had a look at separately disclosable items here. Interest paid, interest received, dividends paid, and tax paid. So we have to adjust this item for all of the separately disclosable items that is included in the net expenses that we don't want there. Under investing activities, we also need to include all the items that has to do with non-current assets. Included in net expenses, I can have items that has to do with the non-current assets. So part of the separately disclosable items can be a profit or loss on sale of assets. Okay, so we're starting off with this amount, but there's quite a number of adjustments that we need to make. Okay, back to our question. We started off with the 218,480, and now we're going to adjust it for non-cash items and separately disclosable items. The first non-cash item that we're all aware of is the depreciation. If we go to our question, they tell us the following items were included, amongst others, in the calculation of net expenses. So they're identifying some of these items for us. Depreciation, however, is a question mark. As soon as I run into difficulty calculating an amount, my default should be to draw up a T account. Now, which T account can we draw up to get to depreciation? That will be all the accumulated depreciation accounts. Accumulated depreciation for buildings, for plant and machinery, and for vehicles. So we're going to draw up accumulated depreciation accounts to get to the depreciation amount, which is not provided. And that depreciation amount that we've calculated will be added back, deducted from the net expenses, because this is a non-cash item. I'm trying to draw up a cash flow statement of cash flows. So I only want cash paid under other expenses, resulting in an adjustment for depreciation. So we will do those reconstructions now. If we have a look at the other items that they tell us, interest expense, including dividends on redeemable preference shares. Remember, redeemable preference shares with the date of redemption gets classified as a liability, resulting in interest rather than dividends. I have profit on the sale of machinery, a loss on the trade-in of a vehicle, dividends received on investments, and then they give me auditor's fees as well. Now, which ones of these did we identify as separately disclosable items? Definitely the interest expense. So interest expense cannot be part of my cash expenses. So I'm going to take out the interest expense here. Profit on sale of machinery. A profit, I cannot have the profit as part of my expenses, but a profit would have been an income item. So I have to reverse that out. So I have to add it back. Then I have my loss on the sale. Loss is an expense, so that expense is included there. I can't have it in there, so I have to take it out by deducting. I have dividends received on investments. That's a separately disclosable item. So I'm going to have to, dividends received again was income. So income gets added back to my expenses. Auditor's fees is not a separately disclosable item, so I'm not going to use the auditor's fees to adjust my interest expense. Now we go back to our depreciation calculation. We want to deduct the depreciation expense because it's a non-cash item, and for that reason we have to draw up our accumulated depreciation accounts. If you have a look at details of property, plant and equipment, there's no depreciation on land. Buildings, we have had accumulated depreciation of 11,000. So the movement from the 11,000 to the 13,500, that will give me 2,500 Rand worth of depreciation for buildings. For accumulated depreciation on plant and machinery, we started off with 67. We ended up with 93, but this movement was not only an increase. If we have a look at additional information number 4, a machine with a carrying amount of 5,600 was sold during the year. New machinery was purchased at a cost of 95, of which 25 was for the replacement of machinery. So you can see that we have not only increases in accumulated depreciation, but also decreases due to the fact that we sold we sold machinery. Drawing up the accumulated depreciation on machinery account, we start off with the opening balance of the accumulated depreciation, the 67,780. We end off with the closing balance of 93,550. But now to calculate the depreciation, we first have to take into consideration the accumulated depreciation on the sold asset, the 12,600. That 12,600 Rand was not provided in my additional information number 4. Machine with a carrying amount of 5,600 was sold during the year. New machinery was purchased, of which 25 was for replacement. They don't mention the accumulated depreciation on the sales transaction, so for that reason we have to also draw up an asset realization account. So we're going over to the asset realization account. In the asset realization account, we need the cost price of the asset that was sold. We need the accumulated depreciation. We need the selling price. And we can calculate then a profit or a loss. Now, in this asset realization account, the only amount that they provided us with was the profit. The profit was a given amount. In my statement of profit and loss, 1,050 Rand. So we can include the 1,050 Rand as our profit on the sale. They didn't provide us with 18,200. They just said that the carrying amount of the machine was 5,600. Now, carrying amount is the difference between cost price and accumulated depreciation. So I still need to get to the cost price of this machine that was sold so that I can include it in my asset realization account. For that purpose, we're going to draw up a machinery account. So you end up drawing up all the accounts related to machinery just to get to the depreciation amount. Okay, so for the machinery account, they told us we had an opening balance of 169,200. 169,200 opening balance. Then we had a closing balance of 246,000. In additional information number 4, machinery purchased at a cost of 95, of which 25 was for replacement. So if 25 was for replacement, the other 70,000, which is the difference between the 95 and the 25, that was then for expansion purposes. So if I have my opening balance plus my additions, the credit side must also add up to 264,200. It only has 246, so my asset realization, machinery is an asset, so that means it decreased on this side. The 18,200 is then my cost price of the disposed of asset. Cost price of the disposed of asset in asset realization, I can include that as 18,200. That was my calculation from the machinery account. If I have the cost price, I can calculate the accumulated depreciation, because cost price minus accumulated equals the carrying amount. So the difference between the cost price and the carrying amount will give me my accumulated appreciation on the sold asset. There I have my 12,600. Difference between the cost price and the carrying amount, 12,600. Once I've calculated this amount, the only remaining balancing amount is the selling price of this asset. This 12,600 accumulated appreciation on the sold asset will have to be a debit in the accumulated appreciation account. Why did we start this whole calculation? So that we could calculate the depreciation on machinery. So that 38,370 will be the amount that gets added to the 2,500 for depreciation for buildings already. We have to follow the same procedure for accumulated depreciation on vehicles, because this increase is not as simple as just calculating depreciation. I also had the trade-in of a vehicle, carrying amount of 18,400, cost of 35,000, traded in for 16,400 on a new vehicle with a cost price of 44,500. So we are again drawing up the accumulated depreciation account for vehicles. Accumulated depreciation for vehicles started off with 25,320. So we have our opening balance. Then we have our closing balance of 31,900. 31,900. Asset realization, they gave you the cost and they gave you the carrying value, so you could determine the difference between the two, which is my accumulated depreciation. So this 23,180 is the depreciation that I have to add back. So at this point, we've calculated the depreciation that we can adjust our net expenses with, 64,050 Rand. If you've adjusted your net expenses with non-cash and separately disclosable items, the other expenses of 143,480 gets added to my amounts that I've already calculated as payments to creditors, movements in accrued expenses, and that 721,130 Rand will be included in your statement of cash flows. In your statement of cash flows as cash paid to suppliers and employees. So at this point, we've already included the whole statement of profit and loss after adjustments for non-cash and separately disclosable items. There I make my little subtotal. Interest paid was a given amount of 12,600. Dividends received was also a given amount of 2,600. And now we get to the dividends paid and the taxation paid. Dividends paid and taxation paid, although they provide you with the tax expense for the year, income tax expense of 62,080, this is not necessarily the amount that you pay to SARS. If you had amounts due from the last year, current tax payable, and you still have amounts due at the end of this year, you did not pay 62,000. You might have paid parts of that, and this is still outstanding. So we need to draw up a T account again to calculate the amount that we actually paid for tax. If we draw up our South African Revenue Services account, we started off owing SARS 8,500 Rand. At the end of the year, we had a balance due to SARS of 10,000 Rand. And during the year, we added to this liability, on the credit side, the income tax expense of 62,080 Rand. Income tax expense. So this income tax expense is an accrual concept. I'm drawing up a statement of cash flows. So I'm not interested in accrual, I'm interested in cash. So I'm interested in the amount on the debit side that actually decreased my liability to SARS. So if I balance this account, at the end of the year, I will get an amount that I paid to SARS of 60,580. So that 60,580 is the amount that I paid to SARS. Taxation paid 60,580. They did it as a mathematical calculation, what I owed at the start, plus my additional liability for the year, minus what I owed at the end. But if these opening and closing balances are not liabilities, it can be an asset as well. Mathematics will not do the job, so you'll have to convert back to drawing up a SARS account. The same goes for dividends paid. Dividends paid, we had dividends payable at the end of last year and at the end of this year. They do tell us that we had dividends of 25,000 Rand on ordinary shares declared. Remember, a declaration does not constitute a payment. So this 25,000 Rand, when it gets added to the opening balance of payable dividends of 7,400, minus what I still owe them, will give me my dividends that I paid of 20,400. So now we're done with the cash from operating activities. Statement of profit and loss, and all the movements in the current assets and current liabilities, because we drew up the T accounts for the current assets and the current liabilities. If we go over to cash flows from investing activities, this is the non-current assets section. So I will have to go to the information that they provide on non-current assets. We already used the depreciation, but that was a non-cash item. So now we're going to go over to the cost price information. Movements in the cost prices of assets, either due to purchases or to sales of these non-current assets. If you look at the statement of financial position, there they just have a total. A total is not providing enough information, so we're going to use the detail so that we can break it down. You have to separate your investing activities into, first of all, purchases of property, plant and equipment and sales of property, plant and equipment. So we have the money going out and the money coming in. For the purchases, we need to make a further differentiation between purchases for replacement purposes and purchases for additions, for expansion. If you don't replace an old asset, you expanded your business. Okay, for these items, if you have straightforward information like this, there was no change in land, you can just indicate that as a no change. For buildings, for instance, it changed from 111,000 to 133,500, so there was an increase of 22,500. This increase does not get influenced by any other additional information, so I can just identify that as either for replacement or expansion purposes. Now, if I didn't sell anything, this could only be to expand, so that 22,500 is under my additions. If we go over to plant and machinery, however, there's a movement from last year to this year, but we had quite a number of transactions regarding machinery. Luckily, we already drew up the machinery account. So if you have a look at the T account that you drew up for machinery, we started off with the opening balance. We included the additions on the debit side, and we included a asset realization on the credit side. So this increase of 95,000 has to be split into for addition and replacement purposes, and they gave us that information in additional information number 4. It was purchased for 95, of which 25 was for replacement. So that 25,000 is the starting point of our replacements, leaving another 70,000 as additions. Okay. For vehicles, we started off with 70,500. There was a movement in vehicles, but it was not only a purchase, we also had a trade-in. A vehicle with a carrying amount of 18,000, cost of 35, was traded in for 16,400 on a new vehicle with a cost of 44,500. So for the vehicles account, you will do a reconstruction again. Okay, so we're going to draw up our vehicles account. You'll remember we only drew up an accumulated depreciation on vehicles account. So we will have to draw up a vehicles account in which we start with the 70,500 as our opening balance. And we have a closing balance of 80,000. Okay. Then they tell us that in additional information number 5, a vehicle with a carrying amount of 18,400, cost of 35,000. So if the cost of the vehicle was 35,000, that means that we got rid of that 35,000 rand. That's for asset realization. Asset realization of 35,000. That was replaced with a new vehicle with a cost of 44,500. So we have a new vehicle with a cost price of 44,500. Now you will see I didn't write bank here, I wrote creditor, because this was a trade-in. And in a trade-in transaction, you are not going to receive the money for the sold vehicle and then pay in a separate transaction the money for the new vehicle. You are just going to net off the amount that you receive for the old vehicle, the 16,400, against the cost of the new vehicle, resulting in your statement of cash flows, an amount that you pay for the replacement of the vehicle, cost price of the new vehicle, minus the selling price of the vehicle traded in. So that 16,400 gets deducted in the creditor's account because this is cash flows, and that will be a net transaction. That is the purchases of property, plant, and equipment. If we look at the proceeds from the sale of property, plant, and equipment, in my asset realization account that we drew up, in the asset realization account that we drew up for machinery, we calculated the cost price, the profit, and the accumulated depreciation, and the only amount that will flow to us will be our selling price. Remember, you won't be happy with only the profit, receiving that in cash, so I'm going to have to use my selling price of 6,650, and that is my proceeds from the sale of property, plant, and equipment. Remember to indicate with brackets whether that was money flowing out or money flowing in. Okay, so we are busy with the non-current assets section of the statement of financial position. We dealt with all of the property, plant, and equipment items. If we look at the statement of financial position, that's not the only non-current asset that we had. We also had financial assets, and the investment changed from 14,600 to 28,000 Rand. That is an increase in the investment of 13,400 Rand. To invest money, I have to take it out of my bank account. So the purchases of an investment will be a money flowing out of 13,400 Rand. At this point, we dealt with the two non-current assets. We already included the current assets. The bank amount of 5,800 is the crux of the statement of cash flows. That 5,800 is my closing balance of cash and cash equivalents at the end of my statement of cash flows. So I'm running through all of these items, and I've already included the cash influence of all of these items in my statement of cash flows. If we now go over to the last part of the statement of cash flows, that is the cash flow from financing activities. This is the non-current liabilities and the permanent equity items. So if we have a look, we already dealt with the trade creditors, the dividends payable, current tax payable, bank overdraft of 10,410 at the start of the year will be included at the bottom. Remember, it's a bank overdraft, so it's a negative cash and cash equivalents. And now we can just have a look at the movements of all of these non-current liabilities, redeemable preference shares and debentures, non-current liabilities, and permanent equity items. I'm not going to have a look at retained earnings, because the movement in retained earnings is represented by the profit. And I've already included all of the profit in my operating activities. So for the ordinary share capital, you'll see there was an increase in ordinary share capital. Increase is an inflow of money as well, 54,600. Proceeds from the issue of shares. If they don't tell you anything to the contrary, you can assume that this increase was paid for. So it was not a capitalization issue or anything like that. Redeemable preference shares, the movement in that is a decrease. So that means that I redeemed the preference shares, a decrease in equities on the debit side. So it's a credit in bank